forecasts aren't for one cut, the forecasts are for several.
So those 4 interest rate cuts starting in February.
As interest rates are cut and come down, it's more affordable for people to pay more for housing, which will then push prices up.
Now is the time to get active and get in the market if you're looking at property. Welcome back to Brick to the Future. A very exciting episode today. We've got our OpenCorp resident nerd, Matt Lewison, co-founder, with us today. So Cam is in a Lewison sandwich there.
Yeah.
And some really exciting, or not exciting, but some really topical things happening in property. So we're looking forward to nerding it up with Matt today to enlighten people with some of the things happening.
Yeah, welcome along, Louis.
Thanks, guys. Looking forward to talking some big numbers.
All right, so we've got rate cuts as basically, I think it's really topical at this point in time. It's going to impact people's lives in a positive way with making lifestyle a little bit easier, but also it's going to make some big changes to the property market. But I first thought, I want Louis, now he often goes a little bit too deep and a little bit too nerdy, so I've given him a challenge to try and just to give people a bit of a premise on what's happened and what the RBA do, what levers they've got, what inflation means, and then we can get into what's going to happen to the property market and people's lifestyle when the rates start to come back down. You reckon you could cram a little bit of an overview of what happened, why the rates started going up?
Sure can.
Yeah.
So obviously when there's more people wanting to buy something than there is a supply of something, prices tend to go up. That's supply and demand. Now, when that happens, and particularly in property, people also get really enthusiastic because prices are going up. So not only are there more buyers than sellers, but those buyers are more enthusiastic. They start paying more. And so that pushes up prices, and that we saw that right through the economy. And obviously the Reserve Bank, one tool to try and push prices down or keep a lid on it is to put interest rates up, because there are so many borrowers across Australia, so many households borrowing. When everyone's interest rate goes up, their borrowing costs go up, they have less money to spend on other things, they also become more pessimistic. So the Reserve Bank also puts out a lot of messages, really negative messages, into the media about, we might keep putting interest rates up. And that's what we've seen over the last year. That's
why scare people to stop.
Absolutely. That's why sentiment has been sitting at GFC levels for the last year until about a month ago, when talk suddenly started shifting to interest rates might start dropping. And we're seeing that sentiment starting to go up now. And obviously, pretty much 95% of all economists in the banking sector now believe that interest rates will be dropping.
All right, so just a quick one, Louis, just because people hear this word constantly through the media, and I hesitate to guess that some people wouldn't understand it. They talk about inflation. Inflation numbers are coming down, so the interest rates will come down. So they've got inflation under control. Tell us exactly what inflation is, just so the average person can understand what's going on.
Okay, so the cost of everyday goods essentially is 100 items that they use to measure it in their basket of goods, and when the cost of those goods go up, they measure it compared to last month and the month before and the month before that. So as those costs jump around, there's a trend across that, and obviously when year on year that the cost of buying that basket of goods has gone up by, for instance, $7, it might have been $100 last year. If it's gone up by a total of 7, then inflation's gone up by 7%. Now the target for the Reserve Bank is between 2 and 3% inflation per year. That's actually set because they actually want prices going up, because when prices are going up generally, people become more optimistic, people invest more. So they don't want prices flat, but it obviously was going up much too fast for the Reserve Bank liking. That's now come back within their target band, and the forecast of inflation is a lot more moderate, and that's why the Reserve Bank seems to have the confidence to be ready to start cutting interest rates.
All right, so we're jumping into the 3 big factors that drive the property market. So just so people are really clear on what we're talking about here. We've got supply and demand, which we know we're not building enough homes. We just established that for the amount of population we've got, let alone the immigration coming in. So we've got a long-term undersupply of affordable housing, which that pushes house prices up. The other single factor that influences house prices is affordability. And that's what we want to talk about today, is as interest rates are cut and come down, it's more affordable for people to pay more for housing, which will then push prices up. So talk us through how that works and what some of these cuts mean as far as a dollar figure in people's back pocket, and then what happens at the bottom end of the market and the groundswell as soon as interest rates coming down, considering consumer sentiment as well.
While you start to explain this, and give you a second to think about your answer that Cam just asked, but people don't talk about it as much anymore, the good old property clock. And they say often they don't ring the bell at the bottom of the property cycle.
Yep.
I'd be pretty comfortable to say that if interest rates after 13 consecutive increases and now a period of time sitting at a set interest rate start to drop, we could ring a bell and go, prices aren't dropping any more than they are right now. Now is a time to get active and get the market if you're looking at property.
Yeah, Tim Lawless came out this week from RP Data and he said the second interest rates start to cut. Let's be really clear, property will never be as cheap as it is today in Australia.
Yep, 100%. So the quickest way for us to just do really simple maths, somebody was borrowing $600,000 today, 0.25%, which is generally what the Reserve Bank cuts. They cut in 0.25%. So to calculate that real quick, 1% of 600,000 is 6,000. A quarter of that is $1,500. So really quickly you can see that if interest rates come down by 0.25%, then somebody taking out a $600,000 mortgage would save $1,500 a year.
$125-ish
straight
per
out.
month. Yeah.
Now, obviously, everyone who's already got a mortgage has got different rates of, they're different amounts that they've borrowed. Somebody who bought a house 5 years ago doesn't still owe what they paid for it. There's normally a bit less. So it's everybody's going to have a little bit more money, or going to have more money in their own pocket. But particularly for people looking to buy houses, is the quickest way for us to determine what's that going to impact on their borrowing capacity and how will that impact prices. So obviously, if you're saving $1,500 a year, then either that's going to make it more affordable for you, or what we tend to see happens is you can borrow more money because your borrowing costs have gone down. And when you look at the numbers, it's about $20,000 to $30,000 on a $600,000 to $650,000 loan.
Just on 0.25%. So people can afford to spend, by just 0.25% rate cut, people can spend 30 grand more on a house.
So what that misses as well, though, is that, and particularly at the bottom end of the market, because the entry price for housing in Australia has been going up steadily for the last couple of years because the cost of building has gone up, cost of buying land has gone up. So the entry price has been going up. Now, there's a lot of people who are priced out of the housing market that just couldn't get a loan sufficient to buy that property. Suddenly, there's a group of people who will have $30,000 extra that they can
get them across the line.
Yeah, to get across the line. So it's not the three of us competing. In that case, there's a fourth person now competing with us.
It's a groundswell of people.
Yes, so obviously there's more competition, and that's going to then start to push prices up from the bottom. Obviously, if you think about it from an auction perspective, if we're at an auction and we're bidding on a weekend and it's been a hot auction market, and I'm not saying it has been, it's actually been soft, but at an auction now there's extra people bidding, or we've just got a bit more money so you can pay that extra bit.
You spend up to your limit, don't you?
You do. Now that's
if that's what's taken to buy it.
Yeah, correct.
Now that's the immediate impact. The secondary impact, and the secondary impact is the much bigger impact, is that once the auction clearance rate starts to go up, once there's more competition at that entry level of prices, suddenly we've got people getting more enthusiastic. Remember what I said about inflation a few minutes ago? That's one of the drivers of inflation is not just demand, but sentiment, that enthusiasm. We're going to start to see that. It takes a few months for that to kick in. But once that happens, then suddenly every man and his dog starts thinking, oh, I need to be in the property market.
That's right. Now
that 240,000 new home target, 162,000 homes were approved to be built in the last 12 months. So that's over 30% shortfall on the target. So there's actually huge demand relative to supply of housing in Australia right now, and the only thing holding the market back has been sentiment. Yeah. So improving borrowing capacity, improving sentiment is going to have a doubly strong effect on the market.
Well, we've seen the amount of people contacting OpenCorp just because there's talk of interest rate cuts. They're getting the confidence to invest. So they're, like you said, it's at the bottom of the market, the bell's about to ring, getting in as fast as you can before the interest rates drop and the market kicks is the key.
So Matt, we talked about the banks. The banks, I guess they'll always win, or they'll always be in front.
Yep.
And when I'm talking to people, they're saying, God, I wish interest rates go back to where they were in COVID when rates were zero. Well, sorry everyone, they're not going to go back to that, not go back to zero. But the forecasts aren't for one cut, the forecasts are for several, and I think the latest I've heard is the forecasts are like 3.44 in 12 months against a 4.25 today. What does that mean for pricing, for housing, and for this supply and demand element you've talked about?
So those 4 interest rate cuts are about, or essentially it's to go from 4.25% down to 3.44%.
Just a forecast.
Is about 4 interest rate cuts, and they'll be potentially staged across the year. So obviously starting in February, then perhaps April, May. But as each of those happen, obviously sentiment's going to improve. But if we just look at raw numbers, borrowing capacity for somebody who could previously borrow about $600,000 is going to go up by about $100,000. That's almost a 20% lift on that entry level property. Now, obviously, for someone who is looking to buy $1 million, the price borrowing capacity won't necessarily go up by $200,000, but we're going to see the biggest impact at the lower end of the market. Obviously, that's before factoring in sentiment and where prices should be, because to put it bluntly, in a market like Melbourne, which has been really depressed by sentiment over the last couple of years, prices aren't capped out on borrowing capacity at the moment. Prices are being capped out on sentiment.
Everyone's just holding back.
Everyone's been holding back, yep. So Melbourne already has capacity for prices to be higher than they are. And if you look at Brisbane as an example, Brisbane's market, the entry price is roughly $100,000 higher than Melbourne already. So if you think about that, Brisbane goes up 100,000, potentially Melbourne 100 to 200,000 capacity for price growth. Might not happen in 12 months, but over 18 to 24 months, there's absolutely that capacity there.
So people who wait are going to miss out on quite comfortably $200,000 over the next 24 months.
So the takeaways, as I'm hearing them, are that we're not expecting one cut, we're expecting multiple. What we're seeing in the key inflation numbers that the government look at is they're heading on a trajectory that will encourage the RBA to drop rates. What that means for the market and for buyers out there is that the bell's ringing. The prices aren't getting cheaper than they are right now. In every state, in every city, we expect growth because people can get more access to money. So the outlook for me would say it's a pretty positive 2025 for property owners.
I couldn't say it any more concisely than that. Yeah.
Thanks for tuning in. For any queries, questions, hello@opencorp.com.au, and don't forget to subscribe. Thanks for tuning in.
If you want to make a quick $200,000, get in touch with